Welcome to Commercial Capital Corner. I'm excited to have you here as we explore the dynamic world of commercial real estate finance. Whether you're an experienced investor, a newcomer eager to learn, or a finance professional looking to remind or expand your expertise, this channel was created to delve deep into all things commercial real estate finance. We aim to simplify complex concepts, share effective strategies, and provide real-world examples to help you understand and navigate the financing and investment of commercial properties. What is commercial real estate finance? Commercial real estate finance involves the methods and processes used to fund the acquisition, development, construction, and management of debt on properties intended as investments for financial gain and/or for business use. Commercial real estate consists of a variety of properties including, but not limited to, office and medical office buildings, retail centers, industrial warehouses and manufacturing facilities, self-storage facilities, hotels, multifamily apartment, and manufactured housing communities. Understanding how these various property types are financed, the financing sources, and how to underwrite these properties are crucial for anyone involved in the industry. The key components of commercial real estate finance are debt and equity. To put it simply, the two of these together complete the capital stack. Debt financing involves borrowing money to purchase, develop, or recapitalize a property. The primary form of debt financing is through commercial mortgages or loans. Lenders, including banks, insurance companies, credit unions, debt funds, mortgage REITs, and other private institutions provide capital in exchange for interest payments and the promise of repayment over time. These loans are typically secured by the property itself, meaning the real estate and related assets owned by the debtor are the primary collateral for CRE loans in the form of a lien on the commercial property. And in the event of a default, the lender can seize the property. Other assets that can be used as collateral include equipment, fixtures, inventory, receivables, and trade accounts. Debt financing is a critical component of commercial real estate, serving several important purposes. Capital acquisition. Debt provides the necessary funds to purchase, develop, or renovate properties without requiring all capital to come from equity. This allows investors to leverage their investments and potentially increase their returns. Cash flow management. By using debt, property owners can manage their cash flow more effectively. Debt financing allows for the preservation of capital, which can be reinvested in other opportunities or used for operational expenses. Financial leverage. Using borrowed funds can amplify returns on equity. If the property appreciates in value, the gains can be realized on a smaller equity investment, maximizing overall returns. Tax benefits. Interest payments on debt are often tax-deductible, which can reduce the overall taxable income for property owners, making debt a financially advantageous option. Risk mitigation. By utilizing a mix of debt and equity, investors can balance their risk exposure. Debt financing can help spread risks across different funding sources. Debt in commercial real estate comes in various forms, each with distinct features and terms. Commercial mortgages. Traditional loans provided by banks, credit unions, or private lenders specifically for purchasing or refinancing commercial properties. These loans typically have fixed or variable interest rates and set repayment terms. Bridge loans. Short-term loans designed to provide immediate funding for properties needing quick capital, often before securing long-term financing. They are typically used for properties that require renovations or are in transition. Construction loans. These are short-term loans used to finance the construction of new properties or major renovations. They are usually disbursed in stages as construction progresses and are converted into permanent financing upon completion. Permanent loans. Long-term financing secured after a property is completed or stabilized. These loans often have lower interest rates compared to bridge or construction loans and are structured for extended repayment periods. Mezzanine financing. A hybrid form of debt that sits between senior debt and equity in the capital stack. It is often used to fill the gap between the amount of senior debt a property can support and the total capital required. Mezzanine loans typically carry higher interest rates and may include equity kickers. Syndicated loans. Loans provided by a group of lenders, often facilitated by an investment bank or financial institution. This form allows for the distribution of risk among multiple lenders and is common for large commercial real estate transactions. Hard money loans. Short-term loans secured by real estate, offered by private lenders or investors. These loans are characterized by higher interest rates and are often used by borrowers who may not qualify for traditional financing. Each form of debt has its advantages and disadvantages, and understanding these options is essential for effectively financing commercial real estate investments. By strategically utilizing debt, investors can enhance their capital structure, manage risk, and optimize returns. The primary purpose of equity in commercial real estate is to provide the necessary capital for acquiring, developing, and managing properties while allowing investors to share in the potential financial returns. Equity financing plays a crucial role in the capital stack, complementing debt financing by providing a cushion for lenders and aligning interests among investors. The key purposes of equity are capital generation. Equity raises funds needed for property purchases, renovations, or developments without incurring debt. Risk sharing. Equity investors share the risks and rewards of the investment, creating a partnership dynamic that aligns interests. Income generation. Equity investors benefit from rental income, property appreciation, and potential tax advantages through depreciation. Long-term growth and appreciation. Equity allows investors to participate in long-term value appreciation, benefiting from the increased worth of the property over time. Equity in commercial real estate can take various forms, each with distinct structures and characteristics. Direct equity investment. Individuals or entities invest capital directly into a property, often through a limited liability company, LLC, or partnership. This form allows investors to have a direct stake and influence in property management and decisions. Private equity firms. These firms pool capital from various investors to invest in commercial real estate. They typically focus on larger deals and provide professional management and expertise, seeking to enhance property value and returns. Real estate investment trusts, REITs. Publicly traded or private REITs allow investors to buy shares in a diversified portfolio of properties. REITs must distribute a significant portion of their income as dividends, providing liquidity and regular income to investors. Joint ventures. Partnerships between different entities such as developers and capital investors to co-invest in real estate projects. Each party contributes equity and shares in profits and risks based on agreed-upon terms. Crowdfunding platforms. Technology-driven platforms that allow individual investors to pool funds for specific real estate projects. This democratizes access to commercial real estate investments for smaller investors. Preferred equity. A hybrid form of equity that provides investors with a fixed return before common equity holders receive distributions. Preferred equity holders typically have priority in capital returns, but may not have voting rights. Each of these forms of equity offers unique benefits and risks, allowing investors to choose the structure that best aligns with their financial goals and risk tolerance. Understanding these options is vital for effectively participating in the commercial real estate market. Commercial Capital Corner is your source for all things commercial real estate finance, with the goal of becoming a central resource for professionals in the industry and any individual who just wants to know more on the subject. Thanks for joining me today. Don't forget to like, subscribe, and hit the bell icon to stay updated with our latest videos. Until next time, keep learning and investing wisely.